Hey, welcome to the binaryedge.net. Let me take you into my office. Actually, I call it the lab because it's it's a little bit more like a lab than an office, which you'll see in a minute here. But anyway, let me take you in there so you guys can get an idea of what we do here at the Binary Edge. So here's the office, or the lab as I like to call it. So let's talk about binary options. Binary options, if you don't know already, are options contracts that allow you to bet on the direction of, a forex pair or a commodity, a stock index, all sorts of different instruments, and you basically you would buy a call binary option, and if the instrument that you bought the call on closes higher than where you bought it at, it doesn't matter if it closes 1 point higher or 300 points higher, you get paid. And that's why it's binary, the definition of binary is that there's only two possible outcomes. Either you get paid or you don't. Now, a lot of people think, or seem to think, that binary options are a scam. And, in a way they are because of the broker spread. So, your broker is going to collect your loss, 100% of it. But when your broker pays you, you only get paid 80% of it, which seems like a lot. It's like, hey, 80% of my money, one trade, 1/2 hour trade, I made 80% of my money. It's great. But over time, statistically, you're going to probably lose. Here's an interesting fact. If you got half your calls or trades correct in binary options, half is, it's decent, you would still lose money. If you got 60% of your trades right trading binary options, you might break even. Probably not. You probably still lose money. Now, it shouldn't be that you can win more than half the time and still lose money, but that's the way it is. And so in order to combat that, what we do here is we use a programming language called Python with the data science library Pandas. What that allows us to do is to sift through years and years of market data and pull out statistics, real statistics for how often certain trade setups will pay out, how many times that they will close above your entry price, thus netting you that big payout. And the idea here is that you don't ever want to trade a setup that has a negative expectancy over time. Now, what's a negative expectancy? A negative expectancy is something like, say, 40%. So if I know that this setup only pays out 40% of the time, if I know this is only a profitable setup 40% of the time, then why would I take that trade? You wouldn't, right? Because over time, if you take a trade that only pays out, it's only right 40% of the time, you're definitely going to lose money. There's no way around that. The problem is most people don't know which setups are bad like that have a negative expectancy, 40%, 35%, and people don't know which setups have a positive expectancy, 60%, maybe more, something like that. Something that gives you the edge against your broker and against the market to stay consistently profitable over time. How many times have you blown an account out? It happens, and the reason it happens is because over time, you don't know the actual statistics behind your trades. And if you're taking suboptimal trades, which means trades that have a negative expectancy, I don't know how much more simple I can put that. You shouldn't be taking trades that are only going to be positive 40% of the time. But of course, you wouldn't know that without doing the statistical analysis, and that's where we come in. We have about 18 pairs right now that we've done statistical analysis for. In most cases, over about 13 years of data. And we're really able to determine the true predictive power of all of the setups we look at. And those are available on the website under historical statistics. So another thing that we offer are rolling statistics. Now what these are is we take the same algorithms that give us the statistics for certain setups, and we apply a rolling window to the data for those algorithms. So what ends up happening is that we're able to see in real time trending setups that are gaining strength, generally due to a paradigm or regime change in the market where a certain trading style becomes favorable. Because as you know, if you're a trader, not everything works all the time. So there may be a great market for buying breakouts that lasts a while, and then that might start becoming negative. So what we do with the rolling statistics is we track the effectiveness of different setups, and we're able to see if a setup is growing in positive expectancy, and then we can allocate more trading capital to it, or if the setup is starting to go weak, and then we can allocate capital away from that setup. Now, while our historical statistics are available to anyone, the rolling statistics are available to members only. So go sign up. Members are also going to get a subscription to our weekly newsletter called The Signal, where we discuss macroeconomic trends that are driving currency, commodity, and equity prices, so we can get together briefly a pretty good outlook for the trading week ahead each week, as well as some updated statistical tidbits to keep you, uh, you know, one or two steps ahead of the market at all time, because that's the game, isn't it? Now, if you don't know anything about trading or binary options, that's fine. Go to our courses section and download our free ebook. It's free. It tells you everything you need to know in case you don't know anything about trading but are interested in learning. Go to our courses section, grab our free ebook. Okay, so come on, guys. Stop gambling in the financial markets. Start trading with an edge and make that edge the binary edge.